Philip Norton here with Norton Trading. Thank you for visiting my channel where we spend our time discussing technical analysis. Please make sure you subscribe so you get all my new videos as they're released. Recently I put out a video about the important basics of technical analysis, which covered the 4 key concepts to address before taking any trade. If you have not watched that video yet, please follow the link at the end of this video and make sure to watch it next. The first step in the 4-step process is identifying a chart pattern. This most often is done from finding a stock either at a trend line or by seeing a change in market sentiment via candlestick pattern. For more information on utilizing trend lines, please see my video Understanding Trend Lines. In this video, we take a look at candlesticks and common candlestick patterns. After this video, you should be able to look at a chart and easily understand what each candlestick is telling you about market sentiment, and more importantly, spot the common patterns that indicate a change in market sentiment. Let's begin first by understanding the anatomy of a candlestick. We get a lot of information just from looking at an individual candle. We not only can tell if the candle is bearish or bullish, but we can see market sentiment as well. We'll use a couple of basic candlesticks to explain this. The first is a doji. A doji is a candle where the open and close are almost at the same point, with about an equal upper and lower wick. As I'm sure you guessed, this candle shows indecision. The price moved very little or even none at all during this candle, and neither buyers or sellers could get control. This type of candle is completely different from a candlestick that has a shaven top or a shaven bottom. Shaven candles indicate that there is no wick at all, either on the top or the bottom of the candle. In a shaven top candle, the candle has closed at or near the high of the candle. This candle sentiment was very bullish, as buying went all the way up until close, and it would be assumed that buying would continue into the next candle. The opposite, of course, is true for a shaven bottom. This is a candle where the close is near the low of the candle, which shows that selling took place all the way into that close and would likely continue into the next candle. The third basic candlestick attribute is a candlestick with a long wick. Now these are more difficult to know if they're bullish or bearish, and you would want to view these within the context of the surrounding candles. I will discuss this further in the next section when we talk about common candlestick patterns. What we do know from a candle with a long wick is that both bullish and bearish sentiment was alive during that candle. If you have a long lower wick, it tells you that there was a lot of selling, but the bulls bought up most of the selling. Whereas a long upper wick signifies early buying, but the bears were up to the task of selling the price back off the highs. While shaven candles alone give you some indication of the candle sentiment, you almost always need more context in the form of a chart pattern featuring multiple candles to provide insight into the sentiment of the stock. Candlestick patterns often have odd but memorable names like Dragonfly, Doji, or Evening Star, which can make remembering them quite easy. Still, many traders often print off candlestick pattern cheat sheets or pictures of these patterns so they can easily spot them in real time. In almost all cases, candlestick patterns work exactly the same from a bullish or bearish perspective, with only the pattern being reversed. Going forward, I will explain the pattern first from the bullish perspective and then from the bearish perspective. The first pattern is the bullish hammer. This pattern is a common long wick pattern at the bottom of a downtrend that could signal a reversal. The hammer has a long lower wick, which shows that there was a lot of selling, but the bulls stepped in and pushed the closing price well off the lows. This is bullish at the bottom of the downtrend, as it shows that the bulls have finally found a price they like and have started to buy. The reverse of this pattern would be the shooting star bearish candle, which has a long upper wick and sits at the top of an uptrend. The long wick shows that while there was a lot of buying early in the candle, the bears have finally arrived and started the selling. It is pretty easy to see how these two candles indicate a change of market sentiment. Another two chart patterns that are almost identical are the bullish Dragonfly Doji and the bearish Gravestone Doji. Just like the hammer and the shooting star, these candles have a long wick at the end of a trend, showing a reversal of sentiment. There isn't a major difference in what you can take away from a hammer versus a Dragonfly Doji or a shooting star versus a Gravestone Doji. It is simply the matter of the body size of these candles. Sometimes we have a candle that appears to show a different sentiment than a pattern. These are a little trickier. The two most common examples of these are the bullish inverted hammer and the bearish version known as the hanging man. Both of these candles, like the hammer and the shooting star we previously looked at, take place at the end of a trend. However, the major difference is the candles themselves are flipped, meaning the inverted hammer is just like the hammer, only upside down. It has a long wick to the upside, even though it sits at the bottom of a downtrend. At first glance, a candle like this may not seem bullish, as it shows that it tried to bounce higher, but the bears were able to sell the price back down. It is actually the fact that there were buyers needed to push the price higher initially that signifies that perhaps the downtrend is coming to an end, and we should watch for confirmation of the reversal. The Hanging Man candle is the bearish version of the inverted hammer. It is a candle at the top of an uptrend with a large lower wick. Just as the inverted hammer, it is the initial selling pressure seen in this candle that gives us the impression that perhaps the trend is coming to an end, and we should watch for confirmation of a reversal. Next, we have a couple of patterns that are a combination of two candles. The first is the bullish and bearish engulfing candles. They are named this way as the candles completely engulf the previous candle. The candle has both a higher high and a lower low. The important piece in these candlestick patterns is that the engulfing candle is in the reverse direction of the previous candle. So in a bullish engulfing pattern, you have a bearish candle followed by an engulfing bullish candle. These candles are very reliable as they show increased action as the price moves from a new low below that of the previous candle to a new high above that of the previous candle, showing that the bulls were out in full force. With a bearish engulfing candle, you have the reverse. A bullish candle followed by a bearish candle that makes a higher high and then sells off to close below the low of the previous candle, signifying that the bears have taken control. Another candlestick pattern that is similar to the engulfing candles is called the bullish and bearish harami. While these candlestick patterns can signify a reverse in sentiment, it isn't as strong as an engulfing pattern. In a harami candlestick pattern, you first have a large candle followed by a second candle that is completely inside the previous candle, meaning it doesn't set a higher high or a lower low. Just like the engulfing candlestick patterns, a harami is a switch in candlestick sentiment. So, a bullish harami would be a bearish candle followed by the completely inside bullish candle. The bearish harami is, of course, the reverse. Like the engulfing candle, this shows a reverse in sentiment, but isn't nearly as reliable as you haven't broken above the previous candle's high. So, while the bulls have started to change the sentiment, you would want to wait until you break the high of the previous candle for confirmation that the bulls are in fact strong enough to follow through with the reversal. The last of these two candlestick patterns is the most common and something you often see against a trend line. This is the bullish piercing line and the bearish dark cloud cover. These candlestick patterns are very strong reversal signals. With the bullish piercing line, in most cases you've had a sell-off down into support, and then you have a candle that opens below the previous candle's close to set a new lower low. At that point, the bulls are able to start buying and push the candle to close higher than the previous candle's high, which clearly signifies that the bulls are now in control. The reverse, of course, is true for the bearish dark cloud cover. You have a bullish candle followed by a bearish candle that opens above the previous candle's high and then sells off to close below the low of the previous candle, confirming that the bears are now in control. The final candlestick patterns that we'll talk about today involve at least 3 candlesticks in the pattern. Now, as noted, most of these patterns happen at the end of a trend to signify a change in sentiment, but the patterns themselves is how you spot the change. The first 3+ candlestick pattern is the bullish and bearish abandoned baby patterns. These patterns involve a large candle in the direction of the trend, followed by a gap in the way of the trend, then a smaller doji or perhaps single reversal candlestick such as a hammer or a shooting star candle. Then, the following candle you have a trend reversal confirmation candle accompanied by a gap in the reversal trend way. For example, in a bullish abandoned baby pattern, you have a bearish candle, a gap down into an indecisive candle such as a doji or maybe a smaller hammer. Then the following candle gaps up and starts a move higher, confirming the reversal. This pattern is often seen at the end of a huge trend. The move is exhausted and the gap down is the bear's final push lower, but the candle finds supports and the bulls take this opportunity to switch the sentiment by jumping in on the big dip and buying up the stock, which is accentuated by the following gap up before the next candle. Of course, the bearish version is the exact opposite layout, seen often at the top of a run up. There is a slight variation of these candlestick patterns, which just doesn't have the second gap. These patterns are called the bullish morning star and the bearish evening star. In the morning star, you still have the bearish trend with the gap down and the smaller doji or hammer candle. Only on the third candle, it doesn't gap higher, just simply starts the move from the previous candle's close. The evening star being the reverse at the top of the trend. While the gap in the abandoned baby candles is a little extra power in the sediment change, the reliability of both patterns are pretty much the same. These are the key chart patterns I commonly use in my trading to find a change in sediment. I highly recommend familiarizing yourself with them so you're able to spot them in real time, and when confirmation comes, you can make a quick move to maximize your profit. As previously noted, if you haven't watched my video on 4 concepts to identify before taking a trade, please do so, as identifying the chart pattern is just the first step. Additionally, while I broke down most of the common chart patterns, there are many more that I didn't cover. I also didn't speak much on gaps and how those play into the chart patterns as well. This will be covered in another chart pattern video specifically on gaps. Alright, thank you for joining me today, and best of luck with your trading.